Today we're breaking down the October 29th Fed rate cut and what to expect for mortgage interest rates moving forward. Yes, the Fed announced another rate cut, but it's not quite the green light for mortgage rates that you might be thinking. Today we'll talk about why mortgage interest rates didn't really move, what Jerome Powell said exactly about the economy and inflation, and what we can expect for mortgages heading into 2026 and beyond. And before we dive into it, if I haven't met you yet, my name is Connor Webb. I'm a mortgage loan originator licensed in Washington, Oregon, California, Idaho, and Arizona. If you have any questions or if you're thinking about buying, selling, or refinancing in the next year, reach out. I'll have a link in the description of this video to reach out and connect. So starting off, what exactly did the Fed do this week? Well, to start off, the Federal Open Market Committee voted to lower the federal funds rate by 0.25% or 25 basis points, setting a new target range of 3.75 to 4%. This came as data showed that the US economy is still growing moderately, but job growth has slowed and unemployment has ticked slightly higher, signaling a softening labor market. Powell summed it up by stating that the Fed is driving in the fog, that there's relative uncertainty with where things are heading. They're moving carefully, collecting every scrape of data before deciding what's next. The Fed is easing slightly to support the economy, but not declaring a full-blown victory over inflation, as they're still working to get that number down to 2% on an annual basis. They're acknowledging progress without a full-blown slowdown. So why do mortgage rates not drop immediately following a Fed rate cut? Well, here is where most people get tripped up. The federal funds rate and mortgage rates are not the same thing. The Fed controls short-term rates, things like credit cards, car loans, and home equity lines of credit, whereas mortgage rates, on the other hand, are determined by the bond market, specifically the yield on the 10-year Treasury note, which reflects long-term inflation expectations of the economy moving forward, and overall investor sentiment. So even though the Fed cut by a quarter point, mortgage interest rates didn't really see an effect as the bond market had already priced this in. In fact, right after the announcement, mortgage rates stayed relatively flat, hovering in the low to mid sixes in most cases for a primary residence, of course, differing depending on the loan type and the property type. Think of it this way, the Fed sets the tone, but the market decides the melody.